Welcome to the Ideal Investor Show. This is the podcast where we help you challenge your mindset and discover where you are. Tired of stories about other people's success? We can help you change your life, determine your time freedom point, and join us on the journey to financial success. Let's go. Hey, everybody. Welcome back to the Ideal Investor Show, where we bring you great guests and we're talking about how can we actually make positive cash flow, how can we plan for our early retirement, ideally early, and how can we invest in valuable things. And today we have another great guest. Kris Morin is here with us. Kris, welcome to the show.
So thanks for having me. It's my pleasure to be here.
Awesome, and thanks for making the time. We were just reminiscing a little bit about our individually separate but common time, a common denominator with having worked for a while at Accenture and also working in residential real estate. So before we dive a little deeper, tell me a little bit, other than the Accenture part, what's the origin story? How did Kris end up in Three Peaks Capital and doing what you're doing now?
Well, Accenture played a big part in it, right? Because I was on I don't know about you, but I was on a plane probably 48, 50 weeks out of the year, spent a lot of holidays away from family. In my mid to late 20s, when I first started, as a millennial, I wanted to be a CEO someday. I was gunning for the top seat, right? But I was working really hard, trying to move up the ranks, and I was doing well. That was happening. I rose to the management ranks pretty quickly. But I was burning out, right? I realized that earning more title, earning more income came with a tremendous amount of sacrifice. And I started to get to this point where I couldn't really imagine, doing that for another 30 years, right? Oh my gosh, is this what it's really going to take for me to build the kind of wealth that I'd always dreamed of? I don't know that I was ready to actually commit to that. And about the same time, I was 3 years into my tenure at Accenture, the Great Recession happened. And I think that was really the catalyst from there. I watched a lot of people lose their jobs. I watched a lot of people who might have been weeks away from retirement and half their net worth was ripped away, right? And they were forced back either to stay in the workforce, or some folks who were already out of the workforce had to go back into it, right? And so, you combine those two things and I realized was just terrible to me. I wanted to obviously find another way to create a more secure financial future for myself, but also establish additional income streams in the near term so that, if an event like the Great Recession caused me to lose my income, I didn't want to be left on unstable ground. And so that is essentially what motivated me to go and explore how do the nation's ultra wealthy, how do they invest their dollars, right? I knew there was a blueprint out there. All I had to go find it and follow it. And essentially, it doesn't take long for you to do a whole lot of research for you to figure out, real estate is a theme that continues to rise to the top, right? And so, in a matter of months, I had a corporation formed. I was investing in masterminds and taking courses, whatever it took to just kind of put the pieces together. And I think within 90 days, I was buying and flipping residential real estate in multiple markets across the U.S. because I was using my travel at Accenture to my advantage. I knew I was getting up and flying to some other city every single week. And so I thought to myself, why don't I just build a team in that city, right? And every time I moved around with Accenture, I basically established a new team in a new market. And I was off to the races on the real estate front. A good 5 years into it, right? I'm at this point, I'm away from Accenture, but I'm doing well in industry. I was serving in executive roles. So I was growing my career quite successfully. But we're well past the recession. The availability of discounted homes was drying up. That pool of supply was drying up. But I'll tell you, it's a very active business to be in. There's a lot of headaches and a lot of risk. And I remember being in a hotel room in Virginia, and I hung up the phone from a contractor who was just making my life hell at the time. And I remember thinking, this isn't passive income. This isn't why I got into real estate. I don't want to do this anymore. And that essentially actually for a short while stopped my endeavor, this pursuit of building wealth through real estate. And, let the business run itself out. I basically helped some of my employees get jobs with my competitors. And I took almost a year off before I came back. And that's when I started buying multifamily real estate. Fast forward seven or 8 years to the date, that has now become Three Peaks Capital, which is essentially a boutique private equity firm that now specializes in commercial real estate and very specifically apartment complexes in key markets around the U.S.
Very cool. So before we go a little bit deeper on what Three Peaks is doing and offering Did you, during your traditional residential time, consider working with turnkey providers?
Like turnkey providers of
Mm.
real estate?
Yeah.
No, I hadn't, probably to my detriment. I think there's real value there if you can acquire at the right cost basis a turnkey asset so that, you're obviously profitable and you're generating a reasonable ROI. I think that's a very good business model. Not a lot of heavy lifting that you have to do. There's not a lot of babysitting that you have to do, but I was very much in the value add space. I wanted to go into a situation where I can force a massive amount of appreciation. That was just the business model that I followed. I have to tell you though, it's a very good idea. I look back on all of the things that I probably would have done differently, that probably would have been one of them. There were a lot of times where I had either a single family home that I sold or even a small multifamily that I sold. And I never once stopped to think I should just refinance this and hold it. Right. And so I like to brag that I'm a smart guy, but when I think, yeah, I don't even want to tell you that story because it obviously doesn't sound too smart, right? But if I could go back in time, that's certainly something I would do differently.
You see, the thing is, for me, people often argue, especially people who did and do flipping, that you give them a profit that is basically appreciation that you could have if you sold it on your own. But if you're 1,500 miles, 2,000 miles away, right? I don't mind that they make a profit if, like you said, perfectly, all right, if I can meet, for example, the 1% rule from day one, and why not have them have the profit, right? As long as the
That's
numbers
right.
work. And they work much better in Idaho and Illinois and Ohio and than they worked in Santa Barbara, California, right? So
That's right.
yeah. So absolutely aligned with you on that. Now, you said then you transitioned into multifamily as one way to have basically less direct work, I guess, because you would then do professional property management. Can you tell us a little bit, if we compare and contrast the residential side that you started out with the commercial residential? I think we need to distinguish this, especially in this day and age. But right now, how would you
Sure.
draw the comparison?
Really, they're one and the same. It's just a factor of scale, right? And so for me, both businesses, because I am the one operating, I'm the one doing it. I'm not necessarily investing with a turnkey operation. For me, it's active either way. But with the rehabs, with the single family jobs that I was doing, at time I was a marketing person, right? I had to generate the leads and then I had to be a salesperson to close them. And then I had to oversee project management and construction. And I didn't get paid until all of those things were completed under a certain set of guidelines that were all speculation. I anticipated you could do a certain amount of work within a certain budget and a certain time frame and sell it for a certain price. All of that is a gamble. It's all very active and it takes a lot of work to get paid. With multifamily, whether I'm buying 4 units or 400, I can wake up in the morning and choose to do nothing. And I either have 4 or 400 tenants who are paying their rent that month. Right. And so, in that regard, I've established income stream at scale, and it becomes much more passive. Now there's a management component to it, but I would say, the way that my role shifts from like residential multifamily to commercial is on the commercial side, we have third party vendors who are doing
Yeah.
essentially the day to day leasing and management for us. And I oversee them. I'm kind of a portfolio manager at this point, and I have routine meetings with all of our property management companies that work in the various regions around the US who are actively managing our properties day to day. So I would say that's probably the primary difference.
Yeah, absolutely. Now, one thing, and maybe you can touch on this a little bit from a financial perspective, since you have capital in the name of your organization. I've always pointed out that on the traditional residential, so single family all the way to fourplex, you can just, like, for your personal residence, you can get a 30-year mortgage. And if you did it, like a few years ago before Mr. Powell got crazy, you basically set and you know exactly what your payment is and good to go. How is that different in the multifamily?
That's a great question. There's a variety of debt options out there. You can absolutely get long-term fixed rate debt the same way you can with residential real estate. It's not typically as profitable, so you'll see, and typically a lot of operators they're buying underperforming assets. So there might be higher vacancy rates, right? More of the units are actually empty. It's underperforming because more of the tenants aren't paying. It's been subject to bad management, and that therein lies the opportunity to go in and improve the overall management and drive massive value in the property. When you're stepping into a situation like that, the banks, they understand you're stepping into a situation with much higher risk. And although you're an expert and you have a business plan to overturn it, they're essentially taking first position on a very risky asset that's underperforming. And so they don't typically lend long-term fixed rate products on those types of assets. So you might be forced to take more of a short-term, higher interest rate loan where, they're essentially adjusting the debt to the risk profile of the property. The products are sort of also driven by the type of the asset and the situation of the asset, if that makes sense, that you're stepping into. So without going too far down that rabbit hole, I would kind of draw the line there. In a lot of ways, though, it does resemble also residential real estate. If you have a good stabilized asset, there's some good products out there that you can lock in long-term rates.
And I understand that. I mean, one of the things that I've heard, and you can say, yes, that's true, or maybe that's not true. In this initial phase, if you take an asset that is neglected, let's call it that, it's not that uncommon that the maximum you can get is maybe 5 or 10 years, even if you even get to
Right.
10 versus 30. On the other hand, what I think is important for our audience who's always interested in learning new stuff and new variations on real estate, but comes, at least I hope so, from the more traditional residential is also, like when we buy an asset or when I curate something and offer it to my clients, we're basically taking the data in a comparative analysis way, right? We're saying, okay, within a half mile or 2 mile, whatever the radius is that makes sense
Mm-hmm.
around a property that we're considering to purchase. Let's compare similar properties with a little bit of a variation to determine price and value. And that's not just us doing so, the lenders do the same thing. Right now, in your case, driving appreciation, I understand, has to do with improving the individual units. But for the initial price, can you, for the audience, describe a little bit how is it that like one place on 123 Main Street goes for 5 million, and 2 blocks further down on 789 Main Street it goes for 10 million, even though they on first glance look like the same 50 or 100 unit apartment complex?
Yeah, the big differentiator usually in situations like that is what we refer to as the vintage, so the age of the property. And so, if something is, inside of 10 years old, we refer to as Class A. Typically, those units are going to trade for a much higher value, even if the apartment complexes, to your point, look very similar. On the outside, the units are of similar size. Say they're all 2 bedroom, 1 bath, 900 square feet. There's a clubhouse and a pool outside. Vintage, because ultimately, for a newer asset, you're not going to deploy a whole lot of capital over time to maintain that asset versus something, a lot of these apartment complexes that are trading today, they were built in the 70s, 60s, or 80s. They've got some wear and tear, and you've got entire mechanical systems that need to be replaced, plumbing, electric, you name it, in addition to upgrading the units. And so for us, comparison really comes down to is all those things. We're looking at the rents that we can command in the marketplace. And I think, so for us, our comparables are the rent comparables. So, for those properties that are nearby, the 2 bedroom, 1 bath, 900 square feet, if it's all newer, it's got granite countertops, all the nicest fit and finish. If they're getting $1,500 a month, let's say, but our asset is older and we're gonna bring it up to sort of a similar build, you're still going to attract a slightly different demographic. So we might say, okay, we sure our units can command say 1,300. And so that's a little bit of where the art and science come in, because the property is ultimately valued based on the amount of income that can bring in. So it's like the best way I always try to explain it to folks who are brand new is evaluating a business, right? You're looking at income and expense and how profitable is it at the end of the day. So it's a lot less about comparables and a lot more about the P&L.
I mean, the way I try to explain it, and you can invite you to say what is wrong in my explanation, is when I always use the explanation to say, okay, if you had 100 units and they make $1,000 rent, right, each unit. So that's basically $100,000 rent. So that's 1.2 million per year. And I don't know what the multiplier is, but let's just say the multiplier would be 5, then it's $6 million value, right? And if you have another similar 100-unit complex and everybody, like you just said, pays 1,500, right? So then obviously that's 150,000 times 12, right? So what is that? That's
Your math skills are much better than me.
yeah. So you end up with 10 million versus 6 million, and
Right.
it's basically a matter. And I think that is, for me, that has always been the explanation. If somebody buys a complex that can only demand with reasonable occupancy the 6 million, and then you start, and every time somebody moves out, you start renovating the unit so you can actually charge the 1,500, you have the opportunity to go from 6 million to 10 million. So I think there is comparison in that way. Would you agree?
Yes, absolutely. Yep.
Okay. Now, I would like to ask you as an expert, basically a little bit as a warning also potentially for our audience and our clients. Obviously, when the time of financing is shorter, let's say anything 5 years, 7 years or stuff like that, and we have this huge jump in interest rates, how important is it to work with like Three Peaks Capital and somebody like with all your background and knowledge, not to fall into a situation where you're getting in an asset and then you find out in a year the financing runs out and they got it at the time for, let's say, 3.5% or 4%, and now they have to jump to 8% and just want to try to get rid of it before the reset. Can you talk a little bit about that?
Yeah. Well, for us, our company particularly, it's very rare that we would ever step into a situation where we're locked into a 5 or 7 year term. We prefer to secure much longer debt, which in our industry, 10 years or beyond is pretty long. And so we'll always put that into place. And so we're creating a lot of runway. And there are exit penalties, sometimes rather steep, that we would incur if we were to exit sooner. But all of that is factored into our business model going in. It's already accounted for in the investment, so it doesn't become a negative shock to that investment later on. But essentially, what that does for us is we always tell our investors it's very typical for a hold period to be about 5 years before return of capital. But we'll put long-term debt in place because if we're coming up on year 4 or 5 and we see some headwinds forming in the economy or a recession falls upon us, we've got the runway. There's more exit opportunities beyond that. We can hold out for the most opportune time to exit. The same had we anticipated a 10-year hold period to begin with. If we see some of those headwinds forming in the outer years, we can exit sooner. And again, any penalty that we would incur for exiting sooner has already been accounted for, so everybody wins. Where you really fall down in the industry is when you take that 3 to 5 year debt up front and now you're locked into it. You essentially have one chance to exit, and that's where a lot of folks are essentially backed into a corner today. The other thing I would say is we always go into deals with much lower degrees of leverage. So we're putting more money down on the property. We're essentially creating more cash flow. We're diluting the overall returns because the more money that we borrow from investors, the more we have to pay back. That dilutes returns a little bit. But in doing so, we're also diluting the risk. That's, a lot of deals are way over leveraged going in with those debts. And so when it comes time to refinance at a much higher rate, their DSCRs, their debt coverage ratios essentially are in very dangerous territory. There's essentially no longer enough money to cover the debt on the property. So for us, the way that we structure our deals up front is if we were to ever fall on tough times, if we were backed into a situation where maybe rates were higher because there was some events that were just completely outside of our control, we're in a much better position because we have a much lower degree of leverage. So we're always kind of thinking through scenarios and anticipating and asking ourselves, how can we take steps now to mitigate those risks later on in the event we just couldn't have seen them coming?
Okay, cool. Sense? And can you put a number to it, like 20, 25%, or is it more? Or
in terms of
the down payment?
Oh, yep. I would say a highly leveraged deal is putting 20 to 25% down. We're putting 30 to 40 and sometimes even as much as 50% down.
Right, which makes it a non-recourse, basically. You wouldn't even have to do DSCR then, right? Cool. So that's kind of interesting. Obviously, it is helpful to have a partner. I mentor my clients, and I would assume you would say something similar, a mentor and coach, to get a full picture, right? Like if I were to say, okay, let's just say we are somewhere in 2021, the last 10 or 12 years history is that interest rates have been relatively stable, fluctuating maybe within 1 or 2%. You're looking at the scenario obviously different. And now in 2024, where within the last 24 months, interest rates went from, like for investment loans, something in the, let's say 4 or low 5s, to 8, right. 9, 10, right? I mean, I wanted to point this out because obviously strategically you have to kind of look at the big picture and say, okay, what is a reasonable expectation? Like you said, right? So if the reasonable expectation is, can we sustain these 8, 9, 10% for anything longer than the next 3 to 5 years? And let's say you ask me, I would say no. The market would not be able to sustain that. So then it would make sense to say, well, okay, then I go maybe with a 7-year term, because then I can exit, assuming that sometime within those 7 years, we're going to get back to maybe not what we were, but significantly lower than we are. versus the other way around. When you were in 2021, you would say, okay, I do 40% down and 15 years if I can get it, or 20, right? Because then you have really no risk. It can probably not get any cheaper, and it can definitely get more expensive, as we have seen. I don't think anybody anticipated it could get this expensive so quick, but that's what I mean by taking a look at the big picture. And that's why for you and me and others in our industry, I always say, if you only get one thing out of listening to a conversation like we have at Kris, is don't try to neglect the 10 or 15 or 20 years of lessons learned that we bring to the table by Googling it or something like that. So that's, in my opinion, the main thing. Yes, obviously, we get paid to some extent for it. But on the other hand, imagine you were to make a mistake. It's probably 10 to 100 times more expensive to recover from it.
Yeah.
Cool. So any other particular thing that you want to point out about Three Peaks that you would say this is something that you don't get anywhere else?
You're essentially getting the opportunity to take advantage of scale in a way that you really can't elsewhere. And multifamily real estate in particular is just one asset class of many in commercial real estate. But it has been pretty much the most stable. Student housing and self-storage have done fantastic, but multifamily housing, there's really no denying its performance over the last 30 to 50 years. And it has remained largely untethered from economic volatility. When the economy's down, rents always go up, right? So the values of our properties always continue to go up, and we always continue to make money. The returns typically, even in a down market like the one that we've experienced in during the Great Recession, even potentially now, you can still anticipate 15, 16, 17, even 18% average annual returns on your real estate investment. So I always tell people, I don't think anybody should go all in, but I think everybody should have a piece of it in their portfolio. And the last thing I'll just offer up, there's an organization out there called Tiger 21. And if you're familiar, essentially I forget the net worth requirement to be a part of this group, but you have to apply. You have to have at least $20 million in liquidity at any given time, or they can kick you out. So these are America's financial elite, and they produce, they publicly publish portfolio allocations for these members every single year. And so you can go look and see how are these people investing their money. And the typical investor, the average business professional has pretty much everything tied up in stocks or in the stock market, 60% in stocks, 40% in bonds. It's the 60-40 structure. If you look at the Tiger 21 members, 80% of their net worth is in various forms of alternatives. 30% is in real estate private equity, 30% is in traditional private equity. And then there's a swath of other alternatives out there. And they only have 19% of their net worth tied up in the stock market. So just food for thought. Real estate has been an investment of choice for the nation's financial elite. And so I think other folks should definitely be looking at it too.
Yeah, absolutely. I'm totally with you. I mean, who would I be to say there is anything other than that to say? And I like that reference to the Tiger 21. Cool. So two quick things, what you said before, for anybody who might be interested after listening to us to get in touch, do you need to be accredited, or you have to have a minimum income, or can anybody be reaching out to you?
That's a great question. Anybody can reach out. There are limitations depending on the deal that they would want to invest in, but anybody can reach out. And I would encourage them to visit our website. It's www.3, it's spelled out 3peakscap.com. Again, that's 3peakscap, not capital, 3peakscap.com. There's a resources section, lots of free downloads, and you can get started there.
Okay, very good. And I always find that important, because sometimes if organizations come on the show and talk about their stuff, if they only accept accredited investors, it's important for the audience to be aware of that. Now, you have used the term commercial real estate a few times. I think we would do a disservice if we not touch very briefly to distinguish between that residential component, like whether I'm doing it for our clients in the traditional, like 1 to 4 units, or you do it for however many units, but apartment units or things like that, versus the other part of commercial. You want to touch real quick on the difference there? Office buildings, malls, any kind of other things that are also considered commercial real estate, but they're not really the same.
So self-storage units, student housing is sort of a form of multifamily. Obviously, office is Office has been the big winner really over the last 30 to 50 years in terms of upside. You typically have very strong Fortune 100 companies signing, decade-long leases, and they don't ever default on their lease, on their essentially their rental income, right? So, Office has been a very high performer, but obviously when a 100-year event like COVID happened, it showed us just how vulnerable Office can be. But multifamily has stood the test of time. To your point, there are lots of different asset classes that are out there. They all come with their different benefits and risks. Multifamily is the swim lane that we like to stay in, but there are lots of opportunities out there, and I would encourage folks to check them all out.
Yeah, absolutely. And you're in multifamily, I'm in traditional residential, and I think we are in a good place because we are serving, if we go with Maslow's pyramid of needs, the fundamental need of shelter. When it's not just COVID, for me, the real impactful longer term development in office or similar things that are related to office is that so many people can now and will potentially continue to work from home, right? Which means only a portion of what used to be in office is ever going to come back. Right. And okay, cool. Two completely unrelated questions to what we talked before that I always ask at the end, Kris. The first one is, if you could meet anybody, who would it be and why?
Eliud Kipchoge. So if you're a runner, then that name resonates. So I'm a big marathon runner. He's the greatest marathoner. He's a Kenyan. He is the greatest marathoner in the world. He's got an absolutely bright mind. I would love to meet Eliud Kipchoge.
And what would you ask him?
I would ask him to go for a run with me. I just want to run with him.
Well, that kind of guy, I would think you have to ask him to go on a walk with you, and you have to run.
That's right.
Up when he's walking. Yeah, those guys are just so amazing. There are these things. It has nothing to do with money, but it's kind of telling the audience a little bit what I can be fascinated about, and I guess you too. Kenya has totally dominated in the last decade, I would say, maybe longer, in the long distance, and then you have places like Jamaica, right, on the short distance. I ask myself, how, right? Is it just because Usain Bolt ran fast and everybody in Jamaica wanted to run fast? Or,
right.
In Kenya, they ran from one hut village to the other, and then everybody saw, oh, you can make money with that, and they started running, or it's just fascinating.
That must be it.
Something like that, right? Okay, cool. And then the last question I always ask is, if you had a time machine, Kris, where would you go and why?
I'm a capitalist and a real estate guy, so I would absolutely go back to 2010, and I would have just started buying multifamily from the get-go, refinancing them, pulling the money out, and I would be in a much greater place right now.
So you would gobble up all the foreclosures, right?
That's right. That's right. Instead of flipping single-family homes, I would have bought lots of multifamily.
Yeah, I'm not sure if that would actually change the time-space continuum, so it might not be allowed, but it's a good idea. All right, cool. Well, Kris, it was a great pleasure to have you. Thank you again for the time. One more time, what's the website?
It's www.3peakscap.com.
Thank you so much, and maybe we do it again.
Thank you.